Welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and today we're diving deep into one of the most debated topics in digital options trading. Should you trade the news, or should you steer clear of it altogether? If you've been trading for a while, you already know that digital options thrive on movement. Price direction within a specific time frame, that's the game. And nothing creates more price movement than major economic news. But that movement can be a double-edged sword. So today we're breaking down the pros, the cons, the strategies, the risks, and how you can decide what fits your style and tolerance. Let's start by zooming out and understanding why fundamental news moves markets at all. Segment 1. Why news matters in digital options. Economic events are like lightning bolts in the trading world. They strike and prices move fast. Digital options traders don't need to predict how far price will go, just whether it'll be up or down at expiry. That makes news events tempting entry points. Let's talk about some of the biggest ones that move the needle. Non-farm payrolls, NFP, released on the first Friday of each month. It measures U.S. employment growth. A strong number typically boosts the dollar. A weak one. Expect the dollar to drop, unless expectations were worse, in which case the market might still rally. Yeah, it gets tricky. Federal Reserve interest rate decisions. These are gold. Literally. They can move currencies, stocks, bonds, and yes, gold. When the Fed hints at rate hikes or cuts, traders pile in, reposition, and the markets get choppy fast. Consumer Price Index, CPI. It's a key measure of inflation. If inflation runs hot, markets start pricing in rate hikes that can push yields higher and impact everything from the dollar to equities. GDP reports, central bank meetings, and corporate earnings. They all play a role. And for those of you trading digital options on individual stocks, earnings reports can create massive, quick price swings. Bottom line, news injects volatility. But is that a reason to jump in or back away? Segment 2. The case for avoiding the news. Let's be honest, not all volatility is good volatility. Here's why many traders, especially beginners, choose to avoid trading around high-impact events. First, the market doesn't always react logically. You might see a fantastic jobs report, but the dollar falls. Why? Because traders expected even better. Or maybe it's already priced in. Sentiment, expectations, positioning, they all muddy the waters. So even when the data's clear, the reaction may not be. Second, slippage and poor execution. When volatility spikes, brokers can't always guarantee your strike price. You may enter a trade only to realize it triggered at a worse level than intended. And in the world of digital options, that small difference could cost you the entire trade. Third, broker side restrictions. Some brokers widen spreads or limit trading during news releases. You might not be able to place trades at all, or you may face delayed executions. These are real risks, especially when your whole trade hinges on timing. And finally, emotion. News trading stirs up fear and FOMO, fear of missing out. You see the market spiking and you want in. But that's when discipline breaks down. Many traders overtrade, double down, or abandon their strategy in the heat of the moment. And that's how accounts get wiped out. Segment 3. The case for trading the news. That said, there's a flip side. If you know what you're doing, news trading can offer clean, quick opportunities. The big advantage? Predictable movement. If you anticipate the direction correctly, the price doesn't need to move far. It just needs to finish above or below your strike at expiry. In a fast-moving market, that can happen within minutes. Some traders use straddle strategies. You place a call and a put option at the same time, before the news. If the price breaks sharply in either direction, one trade wins big. The key is managing the cost of both trades and being selective with when you use this approach. Others hedge across multiple assets. Let's say you expect the US dollar to gain after strong CPI numbers. You might buy digital options on US dollar to Japanese yen and sell on euro to US dollar, creating a risk balance setup. And here's a big one, no spreads. Unlike traditional Forex or CFD trading, digital options don't get hit by widened spreads during volatility. Your risk is capped. Your reward is fixed. That predictability is a huge edge if you can handle the fast pace. Segment 4: Best Practices for News Trading in Digital Options. So, let's say you do want to trade news. How do you approach it without getting burned? Start with an economic calendar. Sites like Forex Factory, DailyFX, or your broker's calendar will show you exactly what's coming and when. Set alerts. Don't get caught off guard. Second, scale your risk. Reduce your trade size around high impact events. If you normally risk 2% per trade, maybe drop to 1% or even less during volatile news windows. Third, wait. Let the dust settle. Many traders wait 1 to 3 minutes after a release before entering. That initial knee-jerk reaction, it often reverses. Waiting allows you to spot the real direction. Use short expiry times. News-driven moves are often short-lived. A 5-minute or 15-minute expiry lets you ride the momentum without overstaying your welcome. And finally, confirm with technicals. Yes, it's a fundamental move, but price still respects key levels. Support, resistance, breakout zones, use them to refine your entries. Segment 5: Mistakes to Avoid. Let's run through some common traps. Number 1: Trading without a plan. Winging it during news is gambling, not trading. Know your strategy before the event hits. 2: Ignoring risk management. Even though digital options have defined risk, poor money management, like trading too frequently or increasing size after losses, can blow your account. 3: Misreading the data. You need to know not just the number, but the market expectation. That's the context. A better than expected number only moves the market if it beats forecasts. 4: Overtrading. Some traders get addicted to the rush of news trading. Don't chase every spike. Quality over quantity always wins in the long run. Final segment. So, should you trade the news? There's no one-size-fits-all answer. If you're new to trading, news events might be best observed, not traded. But if you've developed discipline, understand the dynamics, and have a solid plan, these events can offer powerful opportunities. The key is this: know yourself, know your strategy, know your limits. And if you're looking for a trading platform that gives you the tools, speed, and reliability to trade news events or sit them out, head over to crystalballmarkets.com. Their digital options trading platform is designed for speed, simplicity, and precision, especially when the market gets wild. That's it for today's episode of Financial Market Insights for Traders. I'm Sophia. Thanks for listening, and until next time, trade smart and stay sharp.